ladies and gentlemen. Welcome to InsureTalk number 30. Can you believe that? My name is Chriselle Coleman. I'll be your host today, and we're coming to you live from our studios in Sandton, Johannesburg. So the theme for today's InsureTalk is reinsurance. It is something that is very topical at the moment. We're hearing a lot of new comments in the news about the reinsurers are doing this, the reinsurers are doing that, if we talk to our insurance companies around the market, and we are very excited that we have a fantastic lineup of speakers from our headline sponsor today, Old Mutual Insure. Now, Old Mutual Insure is part of the Old Mutual group of companies, South Africa's oldest insurance company. And they are extremely well positioned and well versed to share with us their knowledge on the topic of reinsurance. Before we get into the business of the day, I wanted to tell you something very exciting. During the last month, we have launched the InsureTalk CPD portal. We've seen some comments already in the chat. Where do I get my CPD certificates? I think the team at InsureTalk is, very excited about this launch. So you must go to InsureTalk30, and there you will be able to download your CPD certificate. But the very exciting part of all of this is that all your certificates will be kept there on record in one place at the end of the year or end of the period for CPD cycle. You'll be able to access that information. I'm going to hand you over to our very first speaker now. I'm so excited to hear Willie van Graan speak. Willie is the Chief Underwriter and Reinsurance Officer at Old Mutual Insure. He joined Old Mutual Insure in September of 2016, Old Mutual. Prior to that, he was the executive for facultative at Aon Re. He is currently serving on the board of Old Mutual Short-Term Insurance Botswana as a non-executive director. His career in insurance includes broking, reinsurance broking, and underwriting over the last 24 years. And the topic that he is going to tackle today is the impact of reinsurance on the insurer and the customer. And I am personally extremely excited to hear this discussion today. And I must just say, I wonder if the dreaded grid failure exclusion is going to be mentioned by one of the brave speakers today. So Willie, over to you.
Morning, Chriselle. Thank you very much for that. And good evening to everyone on the call. Before we go into the detail in our presentation, I thought I would just talk to you guys a little bit about, why the impact or how would reinsurance impact insurance companies and through that, the customers of insurance companies. If we look at insurance in its simplest form, it is basically the pooling of risks. So the premiums of many pay for the losses of few. And I think reinsurance basically carries on that concept where insurance companies then pool their risk and share risk with the reinsurers on a global basis. Now, all of us on this call work in the insurance industry, so we understand the importance of it. So insurance markets play an essential role in mitigating risks in the economy by encouraging proper risk management and providing a source of financing to respond to damages and losses incurred by households, businesses, and governments as a result of insured events. So the pooling of these risks faced by many insureds allow for the diversification of those risks across populations, regions, risks, and time. And that leads to a reduction in the overall cost of protection and providing individuals and businesses with the financial protection necessary for making longer-term planning and resource allocation on decisions. So I think if we then take it one step further, the pooling of risks by insurers to reinsurers then allows for further diversification, and in addition to the diversification of risks realized by the primary insurers. And this provides an additional layer of risk absorption capacity at a lower cost that can be achieved in the aggregate by insurance companies individually. And I think lastly, the global nature of international reinsurance markets also allows for some portion of the losses from events to be absorbed by the international markets. And that then therefore diversify the burden away from or a portion of the burden away from the domestic financial system. I want to just maybe quickly use the KZN floods last year as an example. If we look at what happened, that was the biggest natural disaster that our country has faced. And the insurance companies in South Africa, if the insurance companies had to pick up all of those losses, the impact of that event would have been much more dramatic than what it has been. So, I think if you look at a large insurance company like Old Mutual Insure, we don't buy reinsurance, for example, on motor vehicles, etc. But we would buy reinsurance for aggregating losses, like the KZN floods, or, for example, hailstorms where thousands of vehicles can be affected at one point in time on an afternoon on the M1, N1 in Johannesburg. I think all of us knows that is one of the events that can cause a lot of large losses. So I think the main reason is reinsurance helps us to diversify. It helps us to keep the cost of insurance lower for our end user. And now, what is the impact or the change in the market conditions then? How does it relate directly to our clients? So that's what we're going to try and achieve today. So what I want to do in my discussion is I want to highlight some of the changes in the global reinsurance chain today. And Rashad and Stuart will then continue that thread to link how this is going to impact on the customer in the end. Okay. Rashad, if we go to the first slide, thank you. Okay, so guys, January 1 is one of the largest renewal months for reinsurance globally, and also for South Africa. And what we've got on the screen here, what I want to talk about today, is some of the key findings of the recent 1 January renewals. So property was the most challenged sector, and when we talk property and casualty, so that's all the way from household insurance to insurance of large corporate risk in South Africa, with the resultant business interruption that follows, motor vehicles, etc. Okay, so if we look at what the reinsurance market focused on, there was 3 distinct areas. So firstly was pricing, secondly was attachment, and thirdly was coverage. Now, attachment is the retention that insurance companies have for CAT events. So we call it retention or attachment. And then coverage is the type of cover. Okay, so I think common thread throughout the world, and that includes South Africa, is that there were movement in all 3 of those areas. They were obviously different, but a common theme for South Africa and also for the rest of the market is that the reinsurers expected the insurance companies to take more of the risk at the bottom. So that means that our retention have increased. So if you look at the KZN event, again, as an example, in the past, where, just as an example, say and these are just examples, by the way, but if, let's say, for instance, we had 100 million rand attachment, that number could have moved up anywhere to 200, 300, 400 million rand now after 1 January renewals. And that is because the global reinsurance market, and we will go through the reasons why these things have happened. So that's the first big change. The second one is the premium that we as insurance companies have to pay our reinsurers to take on some of our risk. And then lastly is the cover that they would provide us. And as it stands in South Africa, we traditionally bought all perils cover in our CAT programs, and the reinsurers have started pushing back to that. So I think Christelle gave us a cue here to maybe introduce one of the things that the reinsurers are focused on dramatically for 1 January was what we call grid failure or grid collapse in South Africa. And that's obviously a systemic risk that the reinsurers don't want to assume for South Africa or elsewhere in the world. Okay, so that's the coverage part of it. And there were other things. So, for example, reinsurers didn't come outright and said that you're not allowed to provide cover for grid collapse, but they say that they will not cover us for the pooling of those risks. And we were just talking about in my intro that how we pass on risk, it allows us to provide that cover to our clients at a reasonable cost. If we can't do that, then it means that the price of that would have to be much, much higher. And in the case of grid collapse, it will be impossible for us to put a price to it because it's not that clear for us what the total exposure would be, because we won't know, is it going to be 1 day? Is it going to be 10 days? Is it going to be 30 days? So that's the cover, and I want to stop there. We can, and we would invite questions after Rashad and Stuart's conversation on this, and we'd be happy to see if we can answer that. So secondly, then, the imbalance of supply and demand in property cat cover, and the North American market has been hit very hard by Hurricane Ian, and that drove a stressed market, and in some cases led to pricing and structural changes unsupported by technical considerations. Now, what that simply means is that reinsurance, and Rashad and Stuart will get into that in detail, but reinsurers use modeling to provide pricing and to also determine the amount of risk that they would be willing to accept. And what we've seen now is that some of these reinsurers would ask for technical increases in price and retention way in excess of what the modeling would have actually indicated. Okay, so that obviously put quite a lot of stress on the overall system. And what basically happened, we said this is a global system, and what basically happened is, because the price and attachment point in the US changed so dramatically, some of the reinsurers actually decided that they're going to redeploy capacity that they use in other parts of the world to the North American market, because that market is so much more attractive now. That then, in the end, made sure that it's more difficult for other portions of the world, including South Africa, to place the cover that we need in the market economically. Okay. And then, if we move outside of property underwriting, so for example, on the specialty casualty lines, treaty results were highly dependent on prior year results. And what we mean by that is just specifically what the performance of the individual insurer were. So if you could demonstrate good performance to your reinsurers in the past, your renewal was easier. And if you didn't have good results, it would have been much, much more difficult to get the same terms and conditions, or on the really bad end, to actually get the cover in place. We've seen through the 1 January in South Africa and elsewhere. And that actually means that it would make it much more difficult for insurers to take on risks post 1 January. Okay, and then lastly, and very, very importantly, is there was limited new capital inflow through the end of the year process leading into 1 January, as investors held back amid continued cat loss, increased attractive risk-free rates of return, and we'll talk about that a little bit more. But if you just think about the increased interest rates that we've seen globally, their own moderating assets under management, and a desire to assess the degree of the market transition at January 1. So reinsurers, what that means, and their capital providers, their shareholders, were very cautious to deploy new capital at 1 January, and that drives a constrained market. Okay, next slide, Rashad. So obviously, guys, climate change is one of the big risk factors for the insurance/reinsurance industry globally. And we've seen a lot of activity over the last couple of years. If we think about from 2012 onwards, you can actually think of major events happening almost every year. And if we look at what's happened just last year, and this slide doesn't even include Hurricane Ian specifically, but it does mention the rapid hurricane intensification. And if we look at Ian, Hurricane Ian in North America and in Florida, it was the second largest hurricane to ever make landfall in the US, after only Katrina of 2005. Then also that the Western North America wildfires, that was in the press quite a lot. Excessive hurricane rainfall down in Florida. We've now seen massive winter storms, and that's basically after 1 January, but we've seen massive winter storms in California. That's created quite a lot of insured losses. Brazil has had an ongoing drought, and that creates lots of impact on insured property. If you think about wildfire, like we were just talking about the Western North America wildfires as well. If we move over to Europe, France had 2 hailstorms over the course of last year, and one of those hailstorms actually hit the top end of the limits that some of these insurers buy in Europe. Germany, Belgium, we've seen floods. Germany actually had floods 2 years running. We've seen a lot of floods in China. Australia had been, I think, by far the worst hit by floods. I think they had about 4 proper flood losses during the course of 2022 last year. And then South Africa, we've also made global headlines. The slides that we're looking at here has been largely the ones that do have Guy Carpenter on them have been produced by our global broker, Guy Carpenter, and just want to thank them for that. And so if South Africa, little South Africa, if we hit the global headlines of the reinsurance company starts talking about South Africa and South African losses, I think then we know that it is going to be more difficult going forward. Thanks, Rashad. We can move to the next one. Okay, so what we want to show you guys is just basically what we've discussed a little bit already on the first slide, and it just shows the progression of man-made and natural loss events from 1970 to 2021. And we'll delve a little bit in 1 or 2 slides further, we'll delve in what happens if we add 2022 in here. But you can basically see, if we look at the last couple of years, you can see that there's a lot of the high towers are sitting basically from 2010 onwards. And you can see that the headline says 4th highest year on record. Now that's obviously not good news, but if it was only 1 year that was high, then it would have been okay. But it's unfortunately an increasing trend, and this is something that the reinsurers are very, very concerned about. And this is one of the primary reasons when in the lead into the conversation, when I discussed the increased retention and increased pricing, this is one of the major reasons for that. And if you look at the 10-year moving average, and that's the light blue line that you can see, that line is actually increasing dramatically. And if you look at it from 2015 onwards, you can see that it's almost a straight line upwards. Next one, thanks. So again, what we have, market conditions driven by macro influences. And this then is wide of the losses we just discussed. So rising inflation, we've seen that globally. We've seen it in South Africa. We've experienced it firsthand locally in South Africa. Yesterday, very worryingly, our inflation numbers were released again, and we are at 7% again from 6.9 in January. So actually our inflation is ticking up in South Africa, which is worrying, because that then leads to the next one, the rising interest rates. And why is rising interest rates important for reinsurance and insurance? So obviously investors invest in companies like Old Mutual, like the reinsurance companies, because we're listed entities. and they expect certain returns. Now, if we talk about risk-free returns, it is basically what you get when you put money in a bank account. Now, what happens when interest rates are rising? The risk-free return gets bigger. And then people are starting to look at the returns they can get from investing in insurance or a reinsurance company. And they're basically looking at the difference that you can get from investing in an insurance or a reinsurance company and what you can get by putting your money in the bank, simply put. And if that jaw becomes much closer, if it's my own money, I know what I'll do with it. You know, and normally, why would guys invest? Because the jaw is much wider. So the difference in what they can get from investing in an insurer or a reinsurer is much bigger normally that they can get when you just put your money in the bank. So the rising interest rates have then got a big impact on the availability of capital for the reinsurance and insurance market. Obviously, the ongoing war in Ukraine has had a real big impact on the insurance and reinsurance industry. We've seen specific Russia, Ukraine exclusions. We've seen reinsurers really honing in on sanction clauses and sanction limitation requirements in the treaties. If we look at the next one, then supply chain disruptions, I think last year linked with the rising inflation, rising interest rates, we've seen it in motor repair costs locally in South Africa. Because the supply demand, there's an imbalance, it is very difficult. We've seen last year for the first time ever that the value of second-hand vehicles in South Africa has actually increased. So the value of a second-hand vehicle is, lots of people can actually sell a car for more than what they bought it for. And that puts pressure on, obviously, when a vehicle gets destroyed in an accident, when there's a total loss, that means we have to pay out potentially more, and also the increased cost in the parts to repair vehicles. Then climate change anxiety, that is obviously something that we see globally, and especially from investors, because of the uncertainty that comes from the climate change that we see. And if we look at the slides that I've just shown you guys, the first one that we talked about, climate change and the events that we've seen from 2022, we can see that there's an increase in activity. And that obviously leads to increase in anxiety from our global investors. We've discussed the global cat loss activity already. So the last one I want to mention here then is constrained ILS and retro capacity. I'll explain that quickly. ILS is insurance-linked securities, and that is instruments that are used by insurers and reinsurers to sell some of their exposure into the investor markets. Retro capacity is, we're talking about reinsurance here. Retro is then reinsurance for reinsurers. And if those capacities becomes constrained, then it means it will go down the supply chain as well. Thanks, Rashad. Okay, so 2022, another high cat year. Now, if we look at these numbers, there's a, as I said earlier, there's a worrying trend, and I did say look at the increase in the blue line on 2 slides ago. Look at the blue line from 2015, and we can have a look at the numbers here. 2017, 119 billion US dollars paid for cat losses only, so nat cat plus other perils, but only for cat losses. Now in 2017, I'm sure all of you would remember, we had Harvey, Irma, and Maria, the so-called hurricanes that we had in the US that obviously drove the majority of that. And then if we fast forward to 2020, obviously big impacts from the COVID events over the globe. 2021, again, various natural cat events in South Africa. We would remember that we had the riots in KZN and Johannesburg. The majority of those riots from Sastria into the international reinsurance market. So that were picked up by the international reinsurance markets from Sastria. And that has had an impact. I'm sure all of you have seen what's happened to the cost of Sastria cover in South Africa. And then 2022, again, if we look at that, I did discuss earlier that we had losses on each and every continent last year that contributed to the 119 billion insured cat event losses for the year. Now, if we look at it, so over the last 6 years, it's the worst on record in the last decade. And this uncertainty has been fueled by an increasing contribution from secondary perils and unmodeled events. Now, you guys would remember me talking about reinsurers using modeled outputs, and my learned colleagues will explain that in detail to you guys later. So secondary perils are like hail, flood, wildfire, etc. Your primary perils are your wind and earthquake, and those are very well modeled across the world. And the secondary perils have normally, they caused losses, and the reinsurers were happy to pay for those losses because they were always quite low. And 2021, 2022 specifically showed us that that there's an increase in losses caused by secondary perils. Okay, and we did talk about the impact on cover from our reinsurers, and secondary perils is now one of the things that the reinsurers are really, really focusing on. Okay, so cat-affected perils and regions have benefited from significant rate increases within the global rate online index. We've seen a nearly 30% year-on-year increase over the last 5 years in the cost of buying this cover from the reinsurance. And the reason for that's clear is on the screen, and we'll delve into a little bit more detail after the fact. Okay, let's go to the next one. Thank you. So if we look at global large loss activity from 2013 to 2022, I'm not going to spend a lot of time on this one, but the projected annual large loss total for 2022 was 119, 50-odd billion of that was driven by Hurricane Ian. The timing and magnitude of Hurricane Ian precipitated an outsized impact on available capacity for January 1 in light of the stressed market. And the impact of storm surge, flood, and litigation will play a significant role in the ultimate insured and economic losses. That means is in the US, which is a country that suffers quite a lot from litigation, we've seen over the last couple of months after Ian happened that quite a number of the Florida-based insurers have actually gone into they've actually gone under, those insurers, and a lot of litigation is currently ongoing in the US about that. European floods and hail events, Australian floods, and US severe storms were also key factors in 2022 loss experience. Okay. Current loss estimates are subject to change as updated data becomes available. And why is that important? So we've just spoken about what is ILS and retro, and we say that's how you can put your exposures into the investor market. And what happens if loss estimates are not very clear? It means that capital gets trapped, and it means that those entities cannot deploy that capital then until those losses are finally developed. Let's go to the next one. Thank you. Okay, so what we've got on here is the rate online index for global property cat, and rate online is simply a percentage of the value that you buy, of the limit that you buy. So it's a percentage of the limit that you pay away. And if we look at this from 2000 to 2023, we can see that globally prices started increasing back in 2017. We all know that's true. I think South Africa has been shielded by the majority of that maybe other than corporate property, which started increasing, I think, in 2017 because of the losses in South Africa, caused that part of the market segment to start increasing. But you can see here, increased by 27.5%, primarily driven by pricing and attachment point adjustments in the US and Europe. Okay. Let's have a look at the next one, thanks. So this one is US property cat rate online, and you guys might ask, why are we even looking at the US property rate online? I did mention earlier that some of the reinsurers would also look at the markets where they believe they can get the best value for their money. So attachment points move up, premiums move up, etc. And the US, as you can see, have really gone up by 40 to 60% change in the rate online, and that can make it very attractive for reinsurers. Let's next one, thanks. Okay, so European property cat rate online index, and this is important for us because South Africa gets bundled together with the European markets. All the reinsurers see South Africa as part of EMEA, Europe, Middle East, and Africa. And so this is actually what we get grouped with. And you can see that this rate increases is also for the 2023 renewal increased dramatically, where we've seen an average of approximately 30%, reflecting significant risk-adjusted price change. And on top of that, attachment point modifications. And you remember what I said earlier, the retention from 100 to 300-400 million as an example on KZN, and that difference, that 200-300 million rand difference between the two, means that any insurance company that suffered that loss in 2022 will now have to find the capital to pay that additional percentages, say anything up to 150% increase in retention. And insurance companies will have to find that extra money to make sure that we can cover that increase in retention. Thanks, Rashad. Let's go to the next one. Okay, so this is combined ratios for reinsurers, tracked from 2009 until third quarter 2022. Now, a combined ratios you all would be aware of is your loss ratio plus your expense ratio, and obviously 100% represents 100% of the premium income that's been received. This excludes investment income. And if you look at this, you can see that 2017 onwards is not a good picture for reinsurers globally. I mean, 2017, 108, 99, 100, 102, 96.7 and 97.8. So it leaves very, very small margins for the potential profit and then return on equity that these entities has to provide to their shareholders. Let's go to the next one. Thank you. So this slide here, the broad pinkish band sitting between 8 and 12% is the indicative cost of equity. So it's obviously a financial, maybe a guess is not the right word, but let's stick with that for now, of what the expected cost of equity of these different reinsurers are. So that's why it's quite a wide band. And if you look at 2009 to roughly, say, 2014, you can see that in 1 or 2 or 3 of those years, they were just above the cost of equity. And the other ones, they were sort of in the band, so dependent on the individual reinsurers, if they've actually met their cost of equity or not. But after that, you can see a dip down quite dramatically. And that is, again, another problem. So if we look at 2016 onwards, and we look at the blue line there, you can see we go from 10.7 to 8.9 to 7.2 to 6.9 to 5.6 and so forth. And that means that the majority of the reinsurers out there are not covering the cost of equity or capital on what their shareholders put in. So it means that the shareholders are not getting the effective income that they are expecting from their positions in these companies. And you would remember that I talked about the rising interest rates and risk-free investments here. So you put your money in a bank account and you can potentially earn more. If we look at where we are currently, negative returns in 2022, I mean, that sort of tells you that it is going to be quite difficult for people to leave their money there if there isn't a big change. And those big changes we've discussed, it's the retention and price increases. Next one, thank you. Okay. I've spoken to this. I'm not going to spend a lot of time on this. I'm just looking at time. This is basically dedicated capital that are temporarily impacted by unrealized losses. I was talking about some of the trapped capital, and you can actually see that we've had a dip from 2021 to 2022, and that's a problem. If there isn't an increase in capital every year on year, it means that your normal inflationary increases on sums insured, etc., cannot be covered by the capital available in the market. So we know that last year property prices, or the cost of rebuilding rather than property prices, increased in excess of 10%. Motor vehicles, as I said earlier, more expensive, etc. So our overall exposure as insurance companies have increased, and there's less capital available to us to sell some of that aggregate or pooled exposures to the reinsurance world. And that's why then price goes up, retention goes up. Next one, thanks. Okay, so looking to the future, what are we seeing? So challenging January 1 renewals reflect a market seeking a new equilibrium. So if we look at growth from a reinsurance perspective, I just want to mention here, double-digit premium growth continued in 2022, fueled by economic growth and rates. When we talk about 2022, it's the renewals, 1 January 2023, evolving supply and demand dynamics, and I just mentioned the capital position. If there's more demand than supply, you know what's going to happen to the price. Renewal discussion points, I mentioned this earlier, price, attachment, coverage, property versus casualty versus retro versus geography. Reinsurers don't want to look at single line business anymore. So they don't want insurance companies to only offer them one single line of business. So if you've got a diversified business, then it will be easier for you to get your reinsurance, other than where you, for example, only a motor insurer. It would be more difficult for you to place that. Then market participants' behavior varied, and again, those are the reinsurers. Some of them were still happy to take a longer-term partnership view, where others, and especially when you look at some of the reinsurers' share prices, etc., when there was quite a lot of pressure, some of them acted, I think, fair to say, quite badly. And then we did talk about the negative new capital inflows. So I'm not going to spend more time on that. So how are we going to deal with this volatility? So insurers will have to diversify themselves. And that is higher rates, greater risk awareness. That's going to be, what are we doing? And we talked about modeling, and I think Rashad and Stuart will talk to you about that quite a lot. That's going to really be very important here. So how do we make sure that there's diversification from us to our other competitors in the market? And then if you look at the cat losses, we spoke about that, third year greater than 100 billion in the past 6 years. Realized and unrealized investment losses push comprehensive income into the red. That's for the reinsurers, again, that will have an impact on us. I'm not going to talk about capital. We just spoke about that. And the 2023 hot topics. Inflation, we spoke about recession risks. We spoke about financial market conditions. I think we largely discussed that. geopolitics, reinsurance capital, the pricing cycle, and ESG. So these are all the things that we have to have answers for to our reinsurers when we engage with them in 2023 for our 2024 renewal. Okay. Next one, thanks. So I'll then just conclude here. How do we link this then to insurers and our clients? So there was a historic soft market on the reinsurance side, which then obviously flowed into the insurance side. And most of you on the call here will remember that it was, I think, the golden years between 2010 to 2015 or so, when you went to a client to renewal, the question that was asked is, how much is my discount going to be? So that was driven by an oversupply of capital or capacity in the market. And now we are actually getting the reverse of that. So if we look at CPI over the last 10 or 15 years, we'll see that the CPI were higher than the increase in cost of insurance pricing. We know that the insurance actually had negative growth up to, I would say, about 2018-19 in South Africa. So what's the impact of the hard reinsurance market on the insurers? We spoke about this: retention increase, our CAT cost going up, the reinstatement cost. So to reinstate the CAT cover after an event like KZN, it means we have to pay a premium again. And then the reduction in covers. One of them that was mentioned was load shedding, or not load shedding, sorry, grid collapse. All of those, we now have to do something with that. So if we look at the retention increase, and I spoke about it, if you have a 200 to 300% increase in retention, it means that you have to somehow hold that capital, because our regulator, we've got a highly regulated market in South Africa, expects us to hold a level of capital that we can pay for any of those losses at any given time. And if we can't get that protection from the reinsurance market, it means we have to hold that capital ourselves. If we have to hold that capital ourselves, it means that our cost of equity or cost of capital goes up. And that then has got an impact on the products and pricing that we can put out into the market. Okay, so I've discussed this. What's the impact going to be on our policyholders? It is unfortunately going to mean increased premiums. I think we've seen that in the market already. Change in covers, and I don't want to, I'm just going to very general here. I don't want to go into details, but flood is one of the things that I think is going to get a question mark on in South Africa going forward. And if we look at power surge claims, I think the industry have seen a huge increase in those losses, obviously driven by load shedding. And that is how reinsurance then link into the actual end consumer and what impact it will have. Great, thanks, Christelle. Back to you from my side.
Stop it, and please spotlight me.
Thank you, Willie. You definitely delivered on that topic, and I found it particularly interesting to see where South Africa fits into this very complex picture of global reinsurers. So we really appreciate you taking the time to give us such a thorough overview of the current trends in the reinsurance market. Before we get to our next speakers, I want to just say something to everyone else listening to the session today. We've got about 1,800 people on the call today, and everyone's asking for a copy of the presentation. Now, the way it works is, I told you about the portal earlier on, the InsureTalk portal. If you go onto the portal, today's session will be made available there, and you can get all the information that you need there. So please take note of that. Please make sure that you go and register and that you get access to this very, very important information. Like I mentioned earlier, Old Mutual Insure is our headline sponsor for the day, and these events are not possible without our sponsors. So we thank you very much for supporting this extremely valuable, the foremost insurance virtual conference, I would say, on the African continent. So very, very grateful for your support, Old Mutual Insure. I also want to just make another comment. If you have questions, please don't put it into the comment section, put it into the Q&A section so that we can address those questions. There are thousands of comments and they get lost if you have a question that we would like to share with the rest of the audience and get back to you perhaps after the conference today. So please make sure that you use the correct channel to get that question through to us. Now, our next speakers are going to carry on with the theme of the impact of reinsurance on the insurer and the customer. We can't exist without reinsurance, and it's important that even down to the customer, but specifically our brokers, our underwriters, and our insurers, people who sit in the insurance companies, understand how all of this fit together and why we have some years that are more challenging, like Willie has just painted the picture, than other years. So our next speakers are going to be two people on the session, also from Old Mutual Insure. We have first up, I'm going to introduce you to Stuart Green. Stuart is the Head of Capital Modelling and Optimization at Old Mutual Insure. He is an actuary. 18 years of experience in short-term insurance with Old Mutual Insure, covering a wide range of actuarial work throughout his career, with a current focus on building models. And with him on the next session, we have Rashid Ali. Rashid is the Head of Reinsurance at Old Mutual Insure. He's another actuary, highly skilled actuary, with a decade of experience in the general insurance industry, with a deep expertise in reinsurance, pricing, risk management, strategy development, and analytics. So on that note, I'm going to hand over to these gentlemen, and I look forward to your session. Thank you so much.
Thank you, Christelle. I think I'll go first and Stuart will follow after that. Good morning to the audience. Great to be here with all of you. Maybe just a reminder about the Q&A section. If you have any questions, please drop it in there. Between the three of us, we'll try to get to your answers and we'll get to the rest at the end of the session. All right, so let's recap the problem statement. So Willie has outlined clearly the themes from the recent renewal, what it means for the insurers, what it means for customers. So simply, I thought about how we summarize this. So I've gone with climate change and globalization are changing the fundamentals of traditional insurance, and in brackets, reinsurance. Okay, and let's get into why. So climate change is obviously a significant impact. I don't think any of us can deny that it's happening. We've seen the evidence about the number of events in the last few years compared to 30 or 40 years ago. So due to this increase in frequency and severity of natural disasters such as floods, hail, and potentially wildfires in South Africa, as well as hurricanes and tropical storms worldwide, reinsurers are experiencing a higher occurrence of cat losses. And Willie has given us great detail on this. So, there's been substantial financial losses in the last few years. And in some cases, insurers have faced reputational risk, for those who are perceived as not addressing the risk of the climate crisis. Okay, so what do reinsurers do in response, or insurers do in response? Both insurers and reinsurers are investing in climate research and modeling to develop new products and help policyholders reduce their risks. And as extreme weather events become more common due to climate change, reinsurers are re-evaluating their risk management strategies and adjusting pricing accordingly. And we've seen this in the last renewal. So this will result in higher premiums and may eventually lead to increased costs for policyholders, which we'll touch on later. Additionally, reinsurers are progressively incorporating climate change risk into their investment decisions, such as disinvesting from high carbon footprint companies. And we've already seen a lot of reinsurers inquiring about coal investment and open cast mines and the such. Okay, so let's talk about globalization. Globalization alters the nature of risk, with companies becoming more vulnerable to supply chain disruptions, and we've seen this in the last year, and the risk of cyber. We've also observed how the impacts of inflation globally have impacted insurance markets, economies, and eventually the end customer. As Willie highlighted in his speech of the presentation, we've seen the impact on secondhand vehicles because of chip shortages in the vehicle industry. And we've seen the impact of drastic inflation in European markets. Willie also touched on how in South Africa we're used to inflation, but we have seen it increase. And in the latest CPI results, we've seen it still relatively high compared to where we need it to be. The difficulty is that both climate change and globalization increase the complexity and uncertainty of risk, making it more difficult for insurers and reinsurers to accurately assess and price risk. And that's the core of our business. And if we think about the traditional insurance market, it relies a lot on historic data and actuarial analysis. And these are becoming less effective in addressing these new challenges. So the reality is the data that we have, maybe 20, 30 years of data, does not reflect the changing trends and the changing environment in the future. So insurers and reinsurers are responding by adopting new technologies such as AI, artificial intelligence, machine learning to better understand and manage risk, and to remain relevant and effective in the face of a new challenge. And our industry needs to adapt to these changing conditions to remain sustainable and obviously provide our customers with the much needed assistance that they require. So the rest of the slide basically highlights the ecosystem that we live in, where we provide products to customers and insurers and reinsurers having this almost this, not a tension, but a partnership instead of providing much needed capital and protection for the industry. Willie highlighted some of the macroeconomic factors that drive both the supply side and the demand side. So on the customers, inflation is tough for our entire consumer base. We've seen the impacts of inflation on the middle class as more costs increase across the board, from day-to-day groceries to rent to vehicles to all of those things. Salary increases just don't keep up. I think recently I saw the price of groceries CPI sitting at close to like 12 to 13% in the last 2 or 3 months, which is incredible. We need to talk about load shedding, which makes it a tough business operating environment for our businesses and our customers. So it's a tough climate to operate in, both for insurers, reinsurers, and our customers at the end. So Christelle put it very nicely in her intro that insurers can't exist without reinsurance. And this slide talks to that point. We can see that reinsurance is a core enabler of any insurance business. It provides capacity through risk transfer and limits losses to insurance providers. And those are the main reasons for reinsurance. There are multiple others, which we won't get into. The 6 circles around this reinsurance core are not the entire list, but I think it's the 6 main ones that we should probably look at today. So on the pricing side, we've spoken about the direct impact between the hardening reinsurance market and changes in prices, changes in covers, changes in retentions, and how that will ultimately impact the end customer through pricing adjustments. And we'll talk about that in a bit more detail. On the capital side, Willie also touched on how the increasing risk impacts capital and the cost of capital, and how the relative price of capital versus reinsurance cover comes into play. And we also know that how credit ratings of reinsurers themselves impact the capital required. On the product design side, which I probably think is the most important side, because this is the link between us as providers and our end customer, there's impacts on limitations and exclusions, which Willie has also highlighted, and how these will flow into product design. exposure management. So we'll talk about exposure management and how this is traditionally done and how this could be done in the future. The regulator has obviously had a keen interest in climate change. Apologies for that. And has, is really looking to insurers on what we're doing around climate change and what our plans are. And then our claim side is probably the side where every customer really, gets to appreciate why they have cover. We all providers want to have a smooth, clean customer experience where customers, receive the necessary claims protection on time and within the right set of parameters. Okay, so let's jump in. Product. So there needs to be this balance between what our customer needs are and us as an industry creating sustainable product solutions. And there's this tension between profitable products and also providing the best covers and covers that meet the needs of the customer. So we need to strike this balance. Insurers on the one hand want products that are profitable, sustainable, and that protect them from undue risk. Okay, and in order to do that, we need to be able to carefully assess the likelihood of claims and calculate premiums that cover these risks while also generating profit. And on the customer side, customers need insurance products that give them the adequate coverage and obviously reasonable premiums that fit their budgets. And I think that's an important point, okay, given the economic conditions that we're currently in. So to achieve this, insurance companies must make their products to meet specific needs of their target audience while keeping their own financial interests in mind. We must also provide transparent information about terms and conditions, about the policies to our customers so that they make informed decisions. So advice, I think, is becoming a very critical part to the insurance buying process. And I'm eager to see what happens in the next few years with the likes of, solutions like ChatGPT and AI and how that can be used to better inform the customer when they're buying insurance cover. But ultimately, a successful insurance product must offer value to both the customer and the insurance company. So how do we balance this value in light of the changes we've seen in the market? So we've spoken about restrictions in cover, and we've seen big insurers in the country recently release media statements about restrictions or exclusions to both grid collapse and non-damage business interruption covers. And this is because these events can cause significant impact on insurance claims and potentially lead to large losses for insurance companies. And we've seen with COVID how, what a large impact these covers can have when they do arrive at claim stage. But the key thing is that and we spoke about this in the previous slide, in order for an insurance company to assess this, we need to have significant amount of data to price and understand the risk. Okay. And something like grid collapse, makes it very difficult for pricing teams and providers to quantify the risk. And if you can't quantify the risk, you can't price it. And it becomes very difficult to insure it. Okay. Felice spoke about KZN losses and what the impact has been post the KZN floods. We've seen significant increases to policies or risks where they've had significant claims. We've also seen changes to insurance deductibles in the region. And this means that policyholders now have to pay more out of pocket before the insurance coverage kicks in. And where there's no cover, they need to focus a lot on self-insurance and self-protections. Okay. Third point, there's been this recent trend among reinsurers to provide natural peril-only covers, which focuses solely on protecting against losses caused by natural disasters, such as hurricanes, earthquakes, wildfire, storm, hail, and the like. And the reason is why reinsurers do this is because they can better manage their risk and they can reduce the exposure to losses from other types of claims, which are difficult to quantify. But I think the key point is natural peril covers may not be sufficient for our policyholders because it may not protect them against other types of losses such as theft, liability, business interruption, and fire. The last 2 points, opportunity for secondary services. So there's a lot of reading around this, around in addition to the normal risk transfer insurance policies, insurance companies have the opportunity to provide secondary service to customers. These services may include risk assessment and management advice, loss prevention and mitigation advice as well, and also disaster response and recovery. So, increasing the suite of services that we can provide to customers to enable them to better manage in a time of disaster, and also to plan for the way forward. So by offering these services, insurance companies can help their customers identify and reduce exposure, which can ultimately lead to lower claims and premiums. So it's mutually beneficial arrangement. Insurance companies can also play a critical role in helping communities and business recover from natural disasters and other CAT events by providing resources and expertise to support the rebuilding process. And I think this is an important part where us as a community, as an industry can help those that maybe don't have insurance. And something for the greater good of the economy and society to play that role. I think product is the most important piece of the puzzle. It's through products that we have a link to our end customers. It's through our products that customers share the experience through the insurance value chain, all the way from the quote stage at the beginning, through renewal stages, and then finally at claim stage when the need arises. So I guess the question for me is, how do we enable better risks, so the better customers to benefit from their differentiation? How do we allow them to enjoy lower premiums for applying better risk management, for example? And at the same time, how do we lift those customers who need help and need improvement to build a mutually beneficial partnership between customers and insurance companies for the longevity of our industry? Okay. So that's product. Exposure management. So traditional exposure management is often characterized by a limited decision-making process that focuses on a single channel and a single risk. And underwriters typically evaluate the merits of the risk based on the risk itself, the individual risk factors on property risks, and they are multiple, and the surrounding risk factors based on the condition or where the property is. They do this against existing treaty limits or the internal risk appetite of a company, which can be expressed in either some insured terms or EML terms, or even a maximum loss. However, this approach does not provide a comprehensive view of the overall aggregate pool and may overlook the potential impact of new risks or changes to the existing portfolio. So what active management of a portfolio talks about, it's a more holistic approach in which providers consider how each new risk or a change on a current risk affect the overall aggregation pool. Okay. And this is across multiple lines of business or channels or an entire group, which has many individual insurance lines of business. So I think this requires a rethinking of risk appetite on a broader scale, and also may involve the use of algorithms to enhance the decision-making process for underwriting and quoting teams. And we've seen this already. So we've seen this trend in personal lines where it's easier to use large amounts of data and big data to make algorithmic pricing decisions. But I think there's also an opportunity for us to do this on larger commercial portfolios and maybe even corporate property portfolios. Okay. So to take into account this overall impact on CAT events, as well as specific features such as flood or fire perils, there's been various models have been developed globally that help with making these decisions. Some of these models can predict ignition probabilities. So there's models that look at, weather and climate and temperature and seeks to provide a view on the probability of wildfires starting and then how those fires spread, depending on, wind movements and that sort of stuff. There on the flood side, there's flood models that can predict, where floods can occur, how they spread, and what the impact is on the underlying risks. And where data is limited, machine learning techniques can be used to provide significant model uplift, allowing for more accurate risk assessment and better informed decision making. So whenever I talk about this, I am fully aware that we can't substitute good underwriting. And I've worked with, a fair share of really brilliant underwriters at OMI. So it's important that I say that it's important, while we have these modeling techniques that can provide insights, they're no substitute for sound underwriting practices. Instead, they can help bolster existing underwriting practices by providing additional data and analysis to support decision making. Ultimately, the success of any exposure management strategy will depend on a combination of both traditional underwriting expertise as well as innovative tech solutions. So while we need to invest in the cloud transformations and advanced analytics and all these awesome tools, which I do love, we also need to build a future underwriting practice through continued learning development and training programs, such as this one, and the many that happen at insurer level as well. Capital. So I need to be careful what I say here because Stuart's on the call and he's our capital expert. So Stuart, I'm gonna try to do this the best that I can. So in summary, capital is the funds held by an insurer, and Willie talked about this, to protect our policyholder interests with a high degree of confidence. And we fairly, as an industry, we're fairly sound in that regard. And it's all about having enough money aside that if there are future potential losses, that we can protect our policyholders. And I think that's an important statement to make. With that being said, the capital of an insurance company can be impacted by reinsurance. And how this works is when we sign into or get into reinsurance arrangements, we transfer some of our risk from an insurer to a reinsurer. And what it does, it allows the original company to reduce its overall risk exposure. And this frees up capital that would otherwise be tied up to cover the potential losses. So reinsurance is a major insurance capital enabler. And most of the available capital in the insurance market in South Africa is actually provided by reinsurance cover. So there's a very high reliance on reinsurance protection for our market. Willie touched on this earlier as well, and historically, it's been cheaper to purchase reinsurance than to hold additional capital. And that's because there was a softer market. And Willie touched on these points in his points, but I make the point because as the hardening of the cat markets, we may see a switch between this, and it's something we need to keep a look at as the months and the years evolve into the future. I made a very generalized comment about higher sessions leading to lower capital requirements. This is generally the case, but there are limitations on the amount of reinsurance that you can use in practice, in total and per provider as well. And you must also remember that, the more reinsurance you use, there's a higher reliance on reinsurance businesses, which comes with their own, likelihood of them failing. And we've seen, in the last week or two where specific banks globally have failed. So the more reinsurance you use, there's also an additional capital requirement that you need to hold for them eventually defaulting. But you're getting a bit too technical, but I thought it's an important point to make. So I think in summary, there's a direct impact to capital from the reinsurance hardening. We've spoken about a higher cat retention. So if your cat retention increases, there's a significant increase in the amount of capital you need to hold because inevitably it's no longer the reinsurer that's going to bear that burden, but the insurer themselves. Reduction in covers needs to be, so reduction covers on the reinsurance side needs to be hand in hand with the product side, which we spoke about, top end capacity and number of reinstatements. So generally speaking, the higher the cost of capital due to reinsurance will more likely lead to pricing increases for customers. So in the medium and long term, we may see pricing, and we'll touch into this in the next slide. And I saw some questions in the Q&A, which I'll try to get to as well in the next slide. But how this impacts capital and how this impacts prices, we're in the cycle, and we'll probably need to see what happens at July renewals and subsequently January renewals to see how it all comes together. Okay, pricing. This is a big part of my early career. I actually missed some of it. So a quick pricing 101. So the general principle of pricing involves actuarial analysis to determine the likelihood of an event happening and then how much that event would cost. And insurance companies use statistical data and historical information to estimate these probabilities of these events, such as like a car accident happening or a house fire, or those are specific examples. And when the event occurs, the potential cost. The overall goal of insurance pricing is to ensure that insurance company can pay out claims to a policyholder who experiences insured events while also maintaining the financial stability, number one, and the profitability of the insurance company. So there's also like this balance, and we have to charge enough so that we can meet our obligations, but also ensure that our shareholders are also happy. So let's break this down into pieces. So the first piece is cost of future claims, and I'm referring more to attritional losses, so the day-to-day claims losses. Nothing major, nothing large, nothing catastrophic. And the general approach here has been the use of GLMs, or generalized linear models, for more homogeneous, large amounts of data product lines, such as personal lines and small commercial maybe. But for the less homogeneous, so where risks are more specific, individual, you can't use something like a GLM to price risk. And these are, usually done in conjunction with underwriting, using, maybe burning cost approaches or maybe individual rating. We then need to make an allowance for large and cat losses. And this, we'll touch more about this later. But, there's a lot of reading and an indication that, our traditional approaches are no longer valid, maybe, for how we used to allow for cat losses and large losses. And instead of, simplistic methods, we need more advanced techniques and modeling to adequately price for this type of risk. Okay, and Stuart will maybe jump into that a bit later. Thirdly, we need to make an allowance in our pricing for the cost of reinsurance. Okay, and Vali has spoken about, and I've also touched on the impacts here, but as the cost of reinsurance goes up and cover reduces, this does impact pricing because we expect less from reinsurers in the event of a claim. The fourth piece is expenses. All insurance providers obviously have expenses, direct expenses like commission and binder fees, but also some indirect expenses like, the day-to-day operations of the business itself. And lastly, very linked to capital in the previous slide, is a loading for profit. And this doesn't need to be flat across the board. It can vary by line of business or channel or product. And, in some scenarios, there can be certain products that are loss leaders that don't attract any profit for a period of time to allow a market to grow. And this is very much dependent on the business strategy. So we've spoken about cat frequency and cat pricing and higher retention and change in reinstatements. And those 4 items will definitely impact those components of the pricing formula in a general matter of speaking. And it's all relative to where insurers are moving from. So where they were before the last renewal and where they are now. Okay, and so it's all relative and very specific to every insurer. And as Willie said in his intro, it's very much dependent on the claims experience of each provider. Okay, but there needs to be balance. And I don't think we can simply pass all the cost to customers right away. There needs to be a balanced view on how much of the burden customers can take for how long. We've spoken about the macroeconomic factors, about inflation and other impacts in the economy. So any decision around pricing increases needs to be made very carefully. And I saw some questions in the Q&A around the soft market. I think there will be a natural delay between the hardening of the reinsurance cycle and when prices may increase to the end customer. I think number one, it takes time for pricing algorithms to be updated, for systems to be updated. So there's that operational element, but also there's an element about being fair to customers. And I think being very much aware of what customers can absorb in the short term and how we move in the medium and long term. I also need to make the point that the reinsurance market themselves also needs to factor in price into their pricing considerations, the end customer themselves. And this is to ensure a sustainable future for the industry. In South Africa, our insured population hasn't been growing, a lot. And we need to be very much aware of how we manage the situation and ensure a sustainable future for all. So let me summarize. I think in the last 6 or so slides, there was a lot about different elements of the value chain, but the overall theme was this move from a traditional provider to maybe call it a provider of the future. And over the past year, we've seen the reinsurance market show a strong desire for more detailed information, including exposure data as well as claims history. So there's definitely this increased need for more detailed data. So providers of the future need to make sure that we can provide consistent, accurate, granular data to reinsurers, right? But that means we need to then, source this information from our customers. So we need to provide our customers with innovative ways of them giving us this information. And maybe it's not the usual over the phone form or online form, but maybe we need to find innovative tech ways to get information from clients. And we've seen promise in personal lines, property and motor, where we've seen rating factors increase significantly over time. But there's still areas like commercial, marine, engineering, maybe corporate property, where we can do more to get more granular data to enable differentiation across on our side as well as the reinsurer side. And we've seen differentiation in cases where data has been provided to reinsurers is consistent, accurate, and more detailed. And it's had led to a better decision-making process, a better conversation around rates, and a better conversation around where that overall business is heading, which gives, I think, a reinsurer more confidence on making pricing decisions instead of allowing for uncertainty with maybe some fat in their assumptions. I do want to make one point. I think, however, historically we've relied solely on maybe postal code and Cresta zone information and I think for the level of detail that we need for cat modeling, this level of information is going to be insufficient very soon, and because of the changing landscape. And I think all risks, regardless of size, regardless of complexity, will need to be geocoded in the future, just so that we can understand the impacts of these different perils that Willie spoke about at a more granular level. And Stuart will highlight the importance of this later on in his slides. I guess the question now is whether individual brokers and insurance will tackle this challenge or individually, or maybe as an industry we come together to solve these specific challenges for the mutual benefit of all customers, present and future. Okay. I think in order to take the next step forward, we do need a solid data foundation that enables advanced analytics, such as machine learning and AI. But without this foundation, there's little benefit of employing skilled data scientists and modelers to go about and build these fancy predictive tools. With all types of data intensive work, there's a term junk in, junk out. So you need consistent data to give you the best uplift. So any provider of the future must invest in systems, processes that enable the required modeling down the line. And it's very important that I think everyone in the value chain understands the importance of data. Everything from a simple, maybe an address field that is free text, to detailed information about risks around occupations and types of buildings. There's a lot of things I can probably go on where we face challenges. And I think the last point, it will be if we can get to that level, it'll be mutually beneficial to the entire market. If we are able to assess risk better, we can price it better, and hopefully we can pass some of that benefit back to the customer. And lastly, it enables the modeling required. So on that note, I will now hand over to my colleague, Stuart Green, who is our longest serving actuary at Old Mutual Insure. He has worked across the business. He provides thought leadership across the board and now heads up our capital space. Stuart, over to you.
Thanks very much, Rachel. Would you mind sharing the presentation for me, if you wouldn't mind? Thanks everyone for joining. I think we've had a lot of background information and a lot of, I suppose, more insurer and reinsurer specific information. I think next I just wanted to explore I suppose like more technical side of insurance and reinsurance, and I suppose how that impacts the customer, namely the catastrophe modeling, and going into a little bit more detail about how the models actually work. I do hope you find it interesting, it's not too technical, and hopefully gives you a bit of insight into why accurate policy information is so important and why insurers ask so many questions when you ask for a quote. Also touch a little bit on the impact of climate change near the end of the presentation. Just checking, Rashad, are you sharing it? Okay, cool. Yeah, awesome, thank you. So, okay, if you can go to the next slide. Perfect. So, I think the key things to talk through are what catastrophe modeling is. So catastrophe modeling is basically the science of making predictions about financial risk, both for natural and non-natural catastrophe events. And it's very much probabilistic in nature and looking at how likely things are and how likely it is to cost a certain amount of money. The basic goal is to predict the future losses, do various types of property like motor or homes from the catastrophe events, both for individual properties as well as portfolios of properties and also different types of properties as well. Some of the key questions that the models are designed to answer are where future events can occur, how big the events could be and how often they will occur, and then ultimately what's the potential damage and the ultimate insured loss for the event. I suppose an example of that is how often could one expect property damage of maybe more than R1 billion from floods in KZN, as one question you could ask from a CAT model. Then a common quote that's in the modeling world is, no models are perfect, but some are useful. I think that's the primary goal of the CAT models. It helps people just understand the risk a little bit more. and quantify what the possibilities are. But it won't ever tell you what's going to happen, just gives an indication of what is likely or not likely. Okay, you go to the next slide, please. And so why do we do it? We want to anticipate the likelihood of and severity of potential future catastrophes so that we can prepare for the financial impacts of them. So they are used extensively both by a number of people, insurers, reinsurers, as well as governments, and in some cases the capital markets. Some of the types of catastrophes where there are models in the market, so the hurricane or tropical storms. In South Africa, these generally only have a secondary impact. So we generally see heavy rains related to a tropical cyclone that moves kind of north of the country. And yeah, rather than what you see in America, where you primarily get wind damage from the storms, and I suppose a little bit of a storm surge. The flood, large ones are relatively frequent in South Africa and can cause significant damage, as we saw last year. Which, as Buddy said, was effectively the worst or the most damaging loss we've seen in our history. Damaging earthquakes are not a very frequent occurrence in South Africa, but they're actually considered the highest the risk. I suppose it's the peak exposure, so the biggest losses could come from earthquakes. They just don't happen very often. But they're nowhere near as, or not expected to be anywhere near as severe as what you might see in Japan or California. So on a tectonic plate boundary, you get much more severe earthquakes than you could get here. That being said, it's still considered our biggest risk. The hailstorms, so those again are pretty frequent in South Africa, and they cause varying types of damage depending on the storm. So effectively, the size of the storm varies quite dramatically. You sometimes get a few hail parts from one storm system, and you get different size hailstorms and different volumes. So in some cases, you get a really large hailstone, and that can cause damage to, like impact damage to motor and property. Versus something like a large volume of small hailstones, where your motor are less affected, but you can still see a lot of flooding and collapses of buildings just from the weight of the hail. And that's the other factor with hail is the time of day and to some extent the time of year, the day of the year, make a big impact with how many cars on the road when the hailstorm hits. Like Billy alluded to, the highways in the afternoon, when effectively they're just completely full of cars, you'll get a very different cost impact then compared to, say, on a public holiday in the morning, which is not usually when we get our hailstorm. High risks, so these are really complicated to model, but the models are developing and are out there. But they also depend very much on the vegetation and the condition of the vegetation where the fire starts. So often, what you see is if you have a period of a lot of rain, the vegetation grows very vigorously, and then a period of dry conditions drive the vegetation out, and it's generally the vegetation underneath the trees or that is the driver of wildfire. And then if you have really, really hot, windy conditions following that, that's kind of the perfect storm for severe wildfires. And then the winter storms, I've included them because they're a big risk in other parts of the world, but not so much a feature of South Africa. Yeah, and then the man-made ones, I've mentioned terrorism. You also do get explosion or man-made fire type risk. That's generally not widely modeled within South Africa because of the presence of Satria here. But yeah, they would definitely have models for that. Okay, thanks. We go to the next slide, please. So just to give you a bit of a view of the recent history in terms of what types of events more regularly affect South Africa. So you can see here clearly that flood and storm, include hail, are the most frequent events. We do see some wildfires and some drought, where drought is not necessarily a very well insured peril in South Africa. And then extreme temperature is, I suppose, another one that would become more important with climate change. And maybe also just to note, we are talking more about non-life perils. So you would get similar types of models for the life insurance companies, which focus more on the impact on people more than the impact on the property. Yeah. So yeah, next slide. Thanks, Rochelle. So what do we consider in a cat model? So effectively, they're built up of modules, which are kind of common components within each of the model. Then you have a frequency model, so part of the model that simulates the number of events over a specified amount of time. So, for example, the model might generate in one particular year 2 hailstorms at 3 p.m. in the afternoon in April, maybe on 2 different days. That's part of your frequency model. So that part of the model governs how often events happen and when they happen. The next part of it would be what's called the hazard module. And that's effectively looking at, now that you have a storm or an event that's happened, what does it potentially look like? So kind of looking at the risk and the size of the loss, or the event, sorry, not the loss. So for example, the first hailstorm that's generated by the frequency model might be an event in the south of Gauteng. You'd then estimate the particular size of that event, so it's maybe 120 meters long and 32 meters wide, heading in a northwesterly direction. And that kind of gives you an idea of, I suppose, the size of the area affected. You then also look at what kind of hailstones were generated in that storm. So, for example, maybe hailstones up to about 10 centimeters wide are in the center of the storm, and you get smaller hailstones further out. The next module would be the exposure model, where you overlay either the insurer, the reinsurer, or the government exposure. So we look at, for example, an insurer has 50 properties in the affected area. Look at the sum insured of each of the properties, the type of the roof that is installed on the property, also things like the excess, for example. The last one is then the vulnerability module. And this effectively uses the combination of the hazard module and the exposure model to estimate the size of the loss. So, for example, your one property might be very heavily damaged as it gets within the center of the storm and gets a lot of the larger hailstones, and it has a roof that's effectively more easily damaged by hailstorm versus another property which is on the edge, has smaller hailstorm and maybe made of like a flat reinforced concrete roof, and therefore doesn't really get damaged at all. In general, the cat model use an event-based approach. So effectively, you generate thousands of years of possible data, and effectively in any one year there might be multiple hailstorms, and then each of those is run through each of these modules, so you can get a view of what is likely, what is unlikely, what effectively your sort of worst case scenario. Thanks. Next slide, please, Rochelle. Thanks. So from the aspect of cat modeling, so I think two of the primary metrics are your expected loss. So over a very long period of time, what's the loss that you'd expect from a particular peril. The other one is your maximum loss scenario modeling. So what should you prepare for in terms of the worst case, or worst case scenario is probably the wrong way to put it, but one of the worst case scenarios. And this touches a lot of parts of the business. I think Rochelle and Vidya already touched on some of it, but kind of assist you in determining the price you charge when you really pricing your product, the price for category risk in particular, both on your existing policies and new policies. Portfolio management optimization. So effectively, if you can kind of assess your existing portfolio, and if you were to merge, like bring on an additional UMA, bring on an additional broker, merge with another insurer, how does the combination of your two portfolios affect both the expected loss and the maximum possible loss? on the underwriting risk selections, this is very much at the quoting stage. If you have really good data, really good systems, you can do things like you get a quote in and you can check it against your existing exposure, see how does it change or the expected loss of from your back model, how does it change the possible maximum loss, and effectively determine a custom rate for your new client. And potentially, if you've already got insured clients kind of all along the river, you don't really want to add another one there. You'd rather diversify your portfolio. So you can potentially decline underwriting where effectively it's not really worth it for the insurer to aggregate that additional risk to your portfolio. Loss quantification is also quite useful. So if we do have a severe event like a major earthquake or something like that, you can kind of run the event through the CAT model to see what both the number and the size of the losses you expect from your portfolio, and it allows the insurer to plan better. So if it could send additional claims teams, make sure we can source additional building supplies from potentially overseas. Yeah, but it definitely helps with that. Especially if you've got a remote area. So a good example is in Knysna, when the fire hit, there were definitely not enough people in the local area to deal with all the claims. So, yeah, it does help the insurer to kind of plan for that and send people down, knowing how many of their policyholders are likely to be affected. And then allocation of cost. So there's more of a interest, but it does affect pricing to some extent, where if you more accurately allocate your reinsurance cost and your capital, you can better differentiate your pricing and your profit loadings for different portfolios, depending on the amount of risk they pose. Cost of reinsurance directly relates to the model result, as well as capital, as Richard mentioned. And then definitely used to help set your reinsurance term, how much to buy, how many reinsurance statements are needed based on risk appetite. So, for example, you can look at how many large floods or storms and hail events are reasonably possible in any year, and what the reasonable maximum loss size given your portfolio, and then buy reinsurance to make sure that you are most likely not, or actually you're most likely covered for the most reasonable event. Yeah, thanks, Richard. Next time. I thought I'd just show a quick visualization of how the models work. So you can kind of see the blue ellipse is a possible hailstorm area. That's the oversimplified example. While the orange boxes are indicating potential insurers' properties that are insured. Effectively, what you do is at different points on the ellipse, there'd be different size hailstones. You've got the information about the properties, and you can work out an estimate of how much damage would be done to each of the properties based on the nature of the risk. And effectively, what's happening in the model is they'll generate thousands of these ellipses or possible storms and potentially earthquakes, and assess each one. We can get all the information we need to estimate the losses we'll see in our portfolios. I suppose what this picture also just highlights, touching on what Richard mentioned, is the importance of accurate location data. So if we don't know that these are the insured properties, the orange one, all we know is that we have 5 properties in this spoke code. It's a lot harder to understand how this hailstorm will affect us versus if we know exactly where they are. Especially if effectively the hailstorm is going across 2 postal codes and you've got a line down the middle. Yeah, so accurate information really, really helps with these models. You can also imagine the difference if all the losses, or if the insured all the buildings in the one area or the one block, versus if you've got your risk spread out. This particular hailstorm would affect you very differently. Yeah, thanks, Richard. Maybe just touching a little bit about the actual risk details. So effectively yeah, I suppose it's highlighting the importance of accurate risk information. So an example where you have a wildfire near two different properties. The one is a kind of a steel production warehouse, whereas the other one, which is a fairly open wood factory or wood cutting factory. If there's a wildfire near them, the models kind of consider what, I suppose a lot of the properties are the risk. So for example, the warehouse is not as flammable, generally has a sprinkler system in place. You've generally got parking lots around the warehouse, so there's instead of effectively piled with wood right up until the edge of the fence, and therefore you might expect minimal damage from that. You might also have excesses in place, so the models do allow for that as well, and you might end up having a loss that's less than the excess, or no loss. Whereas for a wood factory that's right next to a forest, all the materials are highly flammable. The fire is really close to the property, you could potentially be exposed to a large loss. Yeah, thanks. That being said, there are definitely limitations on cat model. You definitely need really good data to get the most out of the cat model. So ensure with province versus postcode data versus geocoded coordinates, you'll get much more benefit from more accurate data. There are also a lot of hazards that are more difficult to model. So flood is one of the more difficult ones, where if you look at a high level resolution, so I'll be exaggerating a little bit here, but 100 by 100 meter grids of land, and see how much water falls and then where does it go. It might actually give you a good indication of which properties will actually be damaged by the flood. Whereas if you go really accurate, so 5 by 5 meter grids, or even less, 1 by 1 meter grids, they become extremely computationally intensive. You can imagine you've got the number of 1 by 1 meter grids in a province or even a city, and then you're modeling where the rain falls and where it flows based on the slope, and where it pools and where it goes to the rivers, where it gets back. You have to worry about drainage. It becomes very, very difficult to model it quickly. You kind of have a bit of a trade-off for some models on accuracy versus speed of estimating the risk. And there are definitely some hazards like drought and heat waves, for example, where there aren't currently models available to estimate the impact of those sorts of events. The other key thing is the relationship between the different risk models. So if you've got a model that really accurately models your flood risk and a model that really accurately models your hail risk, you do need to also worry about how you're related. Are you likely to see hailstorms and floods in the same year and the same month, or are they somewhat unrelated? And also worry about different regions. So if you just insure in Africa versus if you insure across Africa, how interconnected are the risks, as whether relatively global. Yeah, thanks. Next slide. So I think you just skipped one. You go on back. Oh, sorry. Thanks. So in terms of the price considerations, I think Michelle touched on quite a lot of this already. I'll just quickly, briefly go through it. We could look at a few of the aspects. So are cap limits appropriate? Does the insurer need a little bit more or less reinsurance cover? Also look at how you layer the reinsurance cover. So reinsurance is not generally bought with one policy almost. You kind of buy it in chunks. So, and the reason you do that is you essentially need to use some of your reinsurance more than once at the bottom. So if you have a few small events, you might need to claim a few times. Whereas for the really big event, you generally only hope to claim once or twice. So you kind of structure your reinsurance that you can actually use it more often for the smaller events and less often for the bigger events. And effectively, the model helps you design your structure to get the most benefit from it. How do you fund your retention? What impact the deductibles have on pricing? So effectively, as the business changes with deductibles, the cat model can give you an indication of how that could essentially reduce the cost of statutory claim, and you can pass those savings on to the customer. which locations are driving your loss estimate. So you can kind of figure out where you don't really want to grow your business too fast relative to the rest of your portfolio, because eventually any growth in a particular area where you're really very exposed is increasing your cap cost disproportionately. Whereas if you were to grow in a very different area, you could actually not even see a change in your cap reinsurance cost. Also helps with cap premium allocation. So figuring out which portion of your portfolio need to pay for your catastrophe reinsurance cover. Okay, awesome. Yeah, next slide, thanks. I think we're going to touch a little bit on climate change as well. So there's definite long-term financial risk associated with climate change, and I think as Richard mentioned, the reinsurers are anxious about it because it's a little bit of an unknown in terms of how it's going to change the emergence of risk over time. And generally when there's a bit of uncertainty, that's when prices go up to effectively mitigate the risk. But some of the impacts of climate change are that we could see increased variability and unpredictability of rainfall and changes in when it rains and where. Higher temperatures also allow air to hold more water vapor, so you can see more rain falling in a shorter space of time than you would have seen in the past. You can also see a change in where hailstorms and tropical storms might occur. We'll see that in the last slide a little bit as well. And there might also be a combination of long-term shifts, so slow gradual warming leading to more variability of rainfall. But you could also see abrupt changes where but one of the most talked about examples is a big ice sheet melting and very quickly changing the oceanic current, which would effectively have a instantaneous and fairly dramatic impact on the weather. Yeah, so it's a lot of uncertainty in this area. Yeah, next slide. So I think just bring this back to South Africa and looking at the long-term climate change risk for us. I think the frequency and intensity of events is changing, the nature of the risk that we are exposed to. And for CAP models, that effectively means we can't just look at the history when we're building our CAP models. We have to really consider what might happen in the future. So what the best CAP modeling companies do is they look for a link to climate-related metrics and effectively build in climate change mechanics within their model. So if you can look at this graph at the bottom, you can very clearly see that this is over a very long time period. So the one on the left is kind of historical, around 2000. One on the right is more about 80 years on. But you can very clearly see that effectively the west of the country is expected to get a lot drier, as well as the interior. And then on your coastline and east of the country, getting a much more kind of tropical environment and much more rain expected over the long term. And that would definitely impact the incidence of floods in the west and the incidence of fires in the west and floods in the east. Yeah, cool. And then last slide. Thanks. So that is sorry.
We've run out of time, so maybe you
want
to summarize and we can do some questions.
Okay, no, sure thing. Yeah, so I think the last thing is just talking about tropical cyclones. Currently got Freddie hitting just north of us, and most tropical cyclones in the past have not hit South Africa. With climate change, that may not be true in future. Yeah, thank you.
Thanks, Stuart. Sorry for rushing you there at the end.
Thanks.
Willie, do you want to maybe take the ILS question? And we'll just do one more in the interest of time.
Yeah, thanks, Rashad. So guys, we'll be quick. On the Q&A, I've seen there was one question on ILS and why, as South Africans, we don't buy into any of the available ILS products, which are cat bonds, parametric bonds, etc. So firstly, parametric bonds, our regulators currently not allowing parametric products in South Africa. So that's one quick answer. But then if we look at the normal cat bonds, it's something that we as a company have looked at specifically. And I think if we look at South Africa and we look at the level of exposure we have in South Africa, the cost that the international investors that are obviously investing in cat bonds specifically, that cost is still mostly quite a bit more expensive than what we can purchase standard cat cover from the market. But it is something that we are certainly investigating and looking at and having constant conversations with some of the major players in that arena. And we believe going forward, it will be crucial for us. Rashad, maybe while I'm on, I've also seen one on Sastria. Just want to have a look at that. And then if there's anything else, we can maybe just decide. I just want to quickly look at the Sastria one. Someone had a comment on Sastria. Yeah, so the comment is, sorry, the July 21 riots reportedly depleted Sastria's available resources. If reinsurance protection was in place, this statement is a bit of a misnomer, unless reference is made to Sastria's own retention. So just quickly, guys, the 21 result, 21 KZN and Gauteng riots blew straight over the that Sastria purchased. So they bought up to a specific amount. Let's put it in thousands. Let's say they bought up to 10,000. And I think the loss, if we sort of say, could go up to 35,000. I must remember, as an insurance company, if you issue policies, that gap between 10 and 35,000, if you don't have reinsurance in place, you have to do it. You have to stand in for that. And that's how we see insurance companies fail. You know, when they don't have enough capital outside of what they buy from a reinsurance. So it means that the modeling they've done never taken into account something like July 21 happened. And I think that's what happened with Sastria. They had their own retention, they had reinsurance on top of it, and it went straight through 2.5, 3 times. And that's the danger of not pegging your extreme events properly. So it exactly ties into what Stuart have just spoke about. And I think that's what happened to Sastria. Maybe back to Christelle to see if there's another minute for if someone else have got a, because I know we're over, if there's another question that anyone would like us to answer. Thank you, everyone.
Thanks, everyone.
Thank you, Team Old Mutual Insure. That was a very comprehensive update, and I think very much appreciated by looking at the activity in the chat box and the request for more information. I just want to highlight one thing that Rashad said that really resonated with me, and that's in this world of data and reinsurance, the role of the underwriter is also still extremely important. Risk selection and being able to provide the correct cover, of course, at the correct price, supported by the reinsurance industry as a whole. So we thank you for that insert. Next up, you know, part of this conference that we have every month, a big driving factor is we want you to stay connected with the industry. And one way in which we do this is to get a 5-minute industry update from Thokozile Mashlanga. She's the CEO of the Insurance Institute of South Africa. And I said to you earlier this morning, we're broadcasting to you live from Sandton. Well, in fact, we broadcast from the IISA offices here in Sandton, and they are also our CPD partners. This event is not possible with all the various role players supporting us, and we thank the IISA for their support, and we look forward to Thokozile's updates on the industry.
Good morning, ladies and gentlemen. It is almost the end of quarter one of 2023. Can you believe it? That means we're almost getting closer to the time for our annual conference, the African Insurance Exchange. As you may be aware, the theme for this year is Collaborate, Cultivate, Create. We are looking forward to hosting each and every one of you. If you have not registered, please take the opportunity to visit our website, go onto the AIE tab and register. So today I'm going to share with you some of the topics that we have lined up for the upcoming conference. One of those topics looks at the readiness of the reinsurance market for a sustainable future, reflecting on all the large losses that we have heard last year and the year before. We sit back and we should be asking ourselves as insurers, as intermediaries, as clients, is the reinsurance market still sustainable? Can it still provide the capacity that is required to ensure that the insurance industry still remains sustainable? Another topic that we're going to look at, and which was really brought onto us unplanned, we all had to just move and get into the digital environment, is whether long-term digital transformation is going to continue. Are we going to continue having to transform and re-transform and adjust ourselves in this digital environment? Is it going to be a permanent thing that we go through? That's one of the other topics we're going to look at. Of course, COVID brought onto us a big impact emotionally and psychologically. We all had to be confined in our homes as we were adjusting to that world. We now have to come out and go back to re-engaging with people. So we're going to have a topic that looks at the prevalence of mental health matters. All this we may be taking for granted, but it all does have an impact on a person. As I said, we had to move from being social beings into being confined in our homes. Now we have to get out of our homes and re-socialize with people and get used to engaging with people again. Another element that we will look at is really how we could collaborate with government, particularly municipalities, in creating a different level of growth, in improving the service deliveries. How can we as an industry collaborate with government and adjust and make sure that we elevate the service delivery and we move forward? Another element which is quite critical, we'll be looking at diversity, equity, and inclusion. There is no doubt that a diverse team succeeds. A diverse team delivers better. Diversity, both in thinking, in age, race, in gender, all that brought together. We know that there's research that shows that, and we've seen it, all of us in all our different organizations, that diversity brings great results. So we're going to have a topic that will unpack that aspect as well. I know we've spoken a whole lot, many times we've spoken about the cyber risks and the impact it has, the protections we need. But this year, we're going to have a different angle to the cyber environment, and we're going to have a different angle where we look at the evolving risks and the evolving landscape, and how do we as insurers respond to that, or how do we as an industry provide solutions to that. We're also going to have take time and look at what opportunities does the challenges that have been brought forward by the impact of ESG. Yes, we've spoken about the economic impact, we've spoken about the infrastructural impact, but what opportunities does it bring to not just the industry, but opportunities that it brings to the economy? We're also going to look at a different angle with all of us working virtually or hybrid models now. There has been an impact on our well-being, and that impact from a physical perspective now, working more at home, we're less mobile, and that less mobility, we've seen research showing that it's leading to more people getting into being admitted or getting into the emergency room. So that's another element that we're going to be looking at. Virtual reality versus emergency rooms. So we're going to have medical doctors coming to unpack that. We're going to have experts from the health industry coming to unpack that for us. And another element that we will look at is we are living longer now as human beings, and then that brings a point where we need to perhaps relook at our retirement insurance in retirement policies. Maybe that needs to be revisited, or maybe the age of retirement needs to be increased or raised. Maybe there needs to be involvement or innovative ways of retirement funding. So that's just to mention a few. As you can see, the topics cover the entire industry, both life and non-life, touching on to retirement, touching on to health matters, touching on to macroeconomics matters, and of course, the technological environment. We cannot wait to host you. If you have not registered, please visit our website and register today. We are already at almost 50% capacity of our target. We cannot wait to host you. Please take this chance and don't miss out before we close registration. We look forward to hosting you.
Thank you so much, Thokozile. You know, I attended the AIE last year. Is it last year? Yes. Yes, last year. And I've been going to this conference for decades now, and I was just absolutely blown away with how the conference attendees have changed, younger, more vibrant. There was much more of an energy in the room. And really, if you have the resources, or your employer perhaps has the resources, there are still a few spots available. Please see if you can attend. It really is a fantastic event to connect with the industry and to grow substantially through professional development. And I also want to do a shout out to Corporate South Africa. Sponsor some young people to go. We want to see more young people at these conferences. You know, get a few sponsorship opportunities and support the event because it's such a wonderful event. Now, our next speaker is another individual that joins us every month, Rianette Whitehead. Rianette is the owner of FA News magazine, but more importantly, she's also the brainchild behind the Insurance Apprentice, something that I am very much involved in behind the scenes because my husband's one of the judges. And this year, I'll also be on the first episode as a guest judge. It's such a fantastic initiative for our industry and again to develop young talent. So I am looking forward to what Rianette has to say and if she's going to give us a little bit of inside information on the show that it's about to start airing all around the market. So over to you, Rianette.
Welcome to InsureTalk30 for 2023. FA News is the official media partner for InsureTalk this year, so my role is to tell you and remind you about the news and happenings in the industry. So let's start. One of the recent developments, which is quite newsworthy, is Chubb pulling their property and casualty business out of South Africa. Accident and health remains in business. Since the last time we spoke, South Africa has also been grey-listed by the Financial Action Task Force. What does it mean for the South African insurance market? South African companies will be subjected to higher levels of due diligence, which will in turn be administratively quite burdensome, and it will create unforeseen costs and will delay the execution of transactions. This will most certainly harm the competitiveness of local companies operating in the global market. Another significant implication is the fact that South African insurance are heavily reliant on reinsurance programs concluded with foreign reinsurers, which will most likely result in the imposing of additional and more intrusive enhanced customer due diligence on local insurers. This will most likely increase the cost of compliance and potentially the cost of reinsurance to local insurers. Thank you, Weber Wenzel, for those insights. On the 29th of March, DocFox, a company which specializes in FICA compliance, will host a webinar on what the grey listing actually means for us, what the practical implications are, and what the responsibility of accountable institutions are around this. We have sent this invite via the FA News website last week, but if you need more detail, just drop me a mail, rianet@fanews.co.za, and I will forward the invite to you. I have mentioned in the last InsureTalk session that FA News does newsletters, we do the website, and we obviously do the Insurance Apprentice. But for now, I would quickly like to remind you of some of the newsletters we've done in the last, say, month or two that really had some good open rates. Those are probably the ones you would want to go and maybe read again. Our newsletters are sent from Monday to Thursday, and it's on topical industry issues. So a few newsletters which is worth mentioning is 8 March, title Flooding Sinks Insurer Profits. 1 March, Brokers, Advisors and their PI Policies, always topical. 28 Feb, good open rate, what the FATF, which is obviously about the grey listing. 17 Feb, think twice before emailing bank details. That was really a good open rate. And then 19 Jan was, do you have 1.5 million Rand plus for cybersecurity compliance? Sensitive topic, and I think a topic you're going to see a little bit more about in the next few months. Another reminder that you can also do your continuous professional development hours with the FA News magazine articles. Our magazine is print and digital. You can do 3 hours per edition, 6 editions. So for us, it's really important to just not do a tick box exercise around our CPD articles. There goes a lot of thought, a lot of planning, and a lot of detail into what we decide has to be CPD articles. So it's worth a read. It's really around development, and you are really learning something. So no cost to sign up to our CPD system, no cost to download the magazine. So make sure you reach out and sign up. So we are busy with our April edition, which will be out soon, mid-April. Topics in this edition include ChatGPT, the importance of going back to basics, trend of stealing expensive cars, conditions of average, and then the whole issue around war, terrorism, and catastrophe in cyber insurance. So I think speaking of CPD, I would like just to mention the following. And I think I'm speaking on behalf of the IRSA, I'm speaking on behalf of the FBI, on behalf of your compliance officer, compliance companies, and employers. A reminder that the CPD deadline is 31 May. To finish and to be done with 31 May. And when I say 31 May, I don't mean you should wait until the 29th or the 30th of May to get those last hours sorted. You have time, people. Do it do it, do it. Sort this out. Yes, we are only in March, but sort this out while you have time. Maybe not a good ad about FA News, but our system crashed on the 31st of May last year because everyone wanted to do their last bit of hours on this last day of the cycle. We had probably around 150 people registering for the first time on our platform. I'm not sure that they managed to come right with us because it was complete chaos. Everything came to a standstill. So just a reminder, make sure you complete those hours well in time. So that's my motherly comment for the day done. A reminder of some good conferences coming up. Insurance Crime Bureau 2023's annual conference is happening on 10 and 11 May with the theme Navigating the Future Through Infinite Opportunities. You can go to the South African Insurance Crime Bureau, saicb.co.za website and just register there. The IIE conference, obviously with the theme Collaborate, Cultivate, Create, is happening from 24 to 26 July for those who have not yet registered at Sun City. It is obviously hybrid as well, but people, this is obviously and always the best place to network. On top of great topics and great conversations happening, the networking is really the reason why most of us are going to this conference. We've all been sitting and doing this hybrid working, not going to the office that much anymore, not seeing people that much anymore. So use this time. If you get it, use it. It's a great opportunity. So make sure you register for that. Speaking of conferences, I don't think I've mentioned a website that FA News has created or have built quite a few years ago. It's called thecalendar.org.za. The whole idea around the calendar is that you as a event organizer or a conference organizer can go and upload your event, any event relevant to insurance and financial services industries. You can go and upload your own event, doesn't matter what it is. There's an opportunity to put banners, links, details. You can upload your event. We get a notification on our side to say that there is an event that has been uploaded, and we approve it on our side. There are no costs attached to it. The idea is that people can go and find conferences and events, and that people don't double book big things on the same day. I have to end with a highlight, which is the Insurance Apprentice Season 9. That is kicking off on 30 March. The teaser for episode 1 has been released last week, and the first episode, sponsored by Discovery Insure, takes our audience on a journey of how we got to the top 10 contestants after receiving around 115 applications. The elimination rounds were so inspiring because I really got to meet so many bright, young, energetic people. And while going through these rounds, the first rounds were sponsored by Aon, and then Discovery Insure was the top 30. I knew that this was going to be another fantastic season. I have to just give one word of thanks and acknowledgement to my two main judges this year, which is once again the amazing Simon Coleman and then Knox Dlamini, who is giving Simon a good go. So make sure you don't miss this. So I will also mention sponsors as we move along the way, because without the sponsors, obviously we can't do much. So the 3 sponsors I would really like to highlight today is Lloyd's. So the winner goes to Lloyd's. They will be attending the Lloyd's Worldwide Broker Forum, and obviously Lloyd's pay for the flights, the accommodation, and everything else, which is a massive prize for anyone working young person working in the short-term insurance industry. Old Mutual ensures another very important and critical sponsor for us because filming happens at the Old Mutual Sandton office, courtesy of Old Mutual Insure. Standard Bank Insurance Brokers, they make sure that our judges and contestants stay comfortable and in luxury during filming week while they are staying at the Standard Bank Global Leadership Center. It is exciting, so please don't miss this. And you can earn 1 CPD hour probably for the first ep and 0.5 to 1. It still depends on how long the episodes are for the rest of the season. So this is me, Rianette Whitehead, FA News Editor and Project Manager of the Insurance Apprentice, signing off. Enjoy the rest of your session and see you in another month.
Thank you, Rianette. I loved that little bit of mom voice that came through there around the CPD points. And it really is such an important thing to remember. It's why many of us are here today to support and participate in this virtual conference to earn very valuable CPD points. And I think today's lineup really talks to the reason why we have CPD, continuous professional development, as part of how we work in this industry. So, Rianette, thank you for that. I really enjoyed your update. It was very comprehensive, and I feel a little bit more informed now about what's going on in the industry. As usual, we have a little bit of a break now with entertainment. We are in the final part of the conference. We've got our entertainment and then one last speaker for you to look forward to. So please grab a glass of water, listen to some lovely music. And our entertainer today is Andy Colombo. She's a singer, playwright, director, and actor from my hometown, Cape Town. She graduated with honors in theatre and performance from UCT in 2017 and has since worked in the live performance and film industries. We look forward to your performance, Andy. Thank you very much.
Hi, my name is Andy Colombo. I'm a musician from Cape Town, and I'm going to be doing some covers for you today. I'm so excited to be part of the 30th edition of InsureTalk. Enjoy. Oh yeah, I'll tell you something. I think you'll understand when I say that something. I wanna hold your hand. I wanna hold your hand. I wanna hold your hand. Oh, please say to me, you'll let me be your man. And please say to me, you'll let me hold your hand. I wanna hold your hand. I wanna hold your hand. And when I touch you, I feel happy inside. It's such a feeling that my love I can't hide, I can't hide, I can't hide. Yeah, you got that something. I think you'll understand when I say that something. I
your face, and the whole world is on your case. I could offer you a warm embrace to make you feel my love. When the evening shadows and the stars appear, and there is no one there to dry your tears, I could hold you for a million years to make you feel my love. I know you haven't made your mind up yet, but I will never do you wrong. I've known it from the moment that we met, no doubt in my mind where you belong. I go hungry, I go black and blue, I go crawling down the avenue. No, there's nothing that I wouldn't do to make you feel my love. The storms are raging on the rolling sea, and on the highway of regret, the winds of change are blowing wild and free. You ain't seen nothing like me yet. I could make you happy, make your dreams come true. Nothing that I wouldn't do. Go to the ends of this earth for you to make you feel my love, to make you feel my love.
Oh, Andy, we are feeling the love. That was so beautiful. I just have to do a shout out to the InsureTalk team for featuring South African artists. This is something that started during lockdown, and we've just seen the most incredible performances over the last 30 conferences. So thank you for making time to entertain us for a few minutes. Before I introduce our final speaker of the day, I just wanted to mention a few things. I told you about the InsureTalk platform to go and register for future conferences. Please do that, and then it's in your diary. You'll get a reminder, and you don't have to worry about your CPD points for the year. The team at CN&CO, who host the InsureTalk conference, are by far the leading conference organizers and hosters in the digital space and in-person events conferences. So if you need support from them, they understand the insurance industry, they understand all the stakeholders and the challenges that we face that's unique to our industry. So please reach out to us if you've got an event. Make sure to make contact with them for at least one of your quotes. And then finally, again, I want to thank all the sponsors, because we are unable to host these events free of charge to the industry if we don't have the support from the wonderful, generous sponsors out there. So we appreciate you very much. Our final speaker of the day, in keeping with the theme of reinsurance, I'm going to read the topic to you because it's quite a long topic, but I'm very excited about the content. So it is a gentleman called Andre Pinar. I'll tell you a little bit about Andre just now. If you don't know him, I'll tell you a bit about him. But the topic that Andre is going to talk to us about is reinsurance in respect of facultative reinsurance from a reinsurer's point of view in the current market in South Africa. So it's all about FAC reinsurance in the current market in South Africa. So Andre is a director of F&I Re. He's been in the industry for more than 30 years. He's part of the 30-year club and has extensive experience in the commercial underwriting and reinsurance underwriting and broking space. Heading up F&I Re, a sister company of the F&I Group, his vast experience within the sectors that he has served in gives him some insights into our market that not many have access to. Andre holds various industry qualifications and a national certificate in wealth management and general management through Wits Business School. And what I really like about Andre's bio is the fact that he understands our business through all the different aspects of it, because he spent time in various parts of the industry. So I look forward to your talk, Andre. Over to you.
From my perspective, I'm already unmuted. Yeah, okay. So also what the nice introduction Christel gave me now is basically I just want to give a brief overview of what's going on. So I'm not going to kill you with a bunch of other like facts and figures and stuff like that. So it's just quickly nicely around lunchtime, may as well that I have to do this that I'm doing this. So let's get straight into it. Right, this is just my index. I'm just going to go through basic types of insurance, basic definition. I just want to recap again, just so everyone's almost on the same page as to where we're not talking about facultative, treaty. You guys already heard from Billy and Rashad and Stuart, and that was very interesting because it actually crosses certain lines with what they had said already. So what to expect going forward. I'm going to mainly speak about the property classes, mainly the higher asset side, not the smaller commercial side, although the smaller commercial side is being more impacted and affected more and more these days as well. And just basically typical information requirements. Rather, Rashad basically spoke about that. On their level, it'll be more about the data. We also collect, as underwriters, we collect a lot of data. And then just side notes, some observations. So just quickly in a nutshell, reinsurance divided into two parts. One is treaty and one's facultative. The area we're talking about is the facultative side, and that's proportional and non-proportional or excess of loss. The treaty side, I'm not going to get very much into. There's a separate thing, people can speak about that. I think Billy and Rashad and Stuart touched on that very much this morning and explained more about where their markets are going, how it influences them as a total insurer. I'm going to speak more about the fact that when the insurer wants to lay off some spot fact risks, they then approach likes of myself or Munich Re or Swiss Re or other reinsurers on a facultative basis. So just a quick definition. I know this is the most complicated part of the whole lot. Facultative insurance, this is a reinsurance for a single risk of a defined package of risks. The insurer is not compelled to submit these risks to the insurer. The insurer is not compelled to write this risk. Each risk is on a facultative contract, is individually underwritten on its own merits of reinsurer. Whereas Billy and them were speaking more about a treaty. Their true renewals, I think, was 1st of January. They spoke about that side. I'm going to speak more about what they call spot fact and inuring fact. When you want to take on a risk and then you find yourself having to either lay off some part of the risk, or you're not too happy about it, you want to lay maybe a portion of the risk over to insurers. But anyway, so the current market conditions, okay, so the property insurance and reinsurance markets has been hardening since 2018. This has been going on quite rapidly, actually. I mean, we're talking about pre-COVID stuff. It was already happening. The last hard market we had was probably 2000, 2001, right about when 9/11 happened. And that lasted about, I think South Africa lasted about 6 to 8 months. The world got a flu and we just got almost like a hiccup of it. Whereas markets in London actually had longer. We have a hardening market, well, a very hardened market at the moment, the property side. As explained again in the previous presentations, that has impacted the treaties. It's impacted a lot of people as well. Now with the inflation factors coming in, it's also been quite hard, especially on the smaller businesses. Capacity has reduced. Some people have pulled back capacity. Some reinsurers have actually gone out of the market internationally because they just weren't strong enough to bear some of the large international losses that occurred. The double half, that's a term which has been used in the reinsurance angle sort of side for the likes of the insurers. When the reinsurance brokers take the clients, the high-end clients, to the likes of a Monte Carlo conference or the Baden-Baden conference, last year, leading up to the 1st of January tree renewal season, reinsurers are talking about the double half. So basically, they were saying, expect double the rates, double the deductibles, and half the capacity. So that has actually occurred as well in most regions. Clever reinsurance brokers have managed to place very difficult treaty in very difficult treaty conditions. They've done a sterling job as far as I'm concerned in South Africa. The onset from that also is like the likes of what like Willie talking about was the restriction of certain covers, flood, etc. like that, more focus on information. Rates have increased substantially on all occupancy types, regardless of what it is. You could be having say a risk class 1, which is like the best ever. They are still probably getting about between 5 to about 15% rate increases, just because of the knock-on effect, which the guys from OMR explained earlier on, the cost effects, what happens on the treaty, etc. Deductibles are more claims frequency related. So when underwriters get it, in reinsurance underwriters like myself gets a risk, we take a look at the deductible. Does it make sense to what actually happened with the claims? Is it necessary? Is the client taking a higher attention because he wants to reduce his impact on the premium? These are the questions which one has to ask anyway, and also see in relation to their claims experience. Would it have made a difference maybe 5 years ago of having an A deductible, and are you doing as-if calculations? Risk management. Now, since the start of the hard market, it's been first and foremost a part of rating for any underwriter. You can't underwrite a risk that is not risk managed, or at least being taken, or having a view, or someone helping with the risk management, finding deficiencies, ongoing ethos within the company. What are they doing to minimize risk? I have seen over the past 3 years, there have been a couple of clients who have been left either uninsured or not fully placed, and they became like a 20% or 30% co-insurer. Now, you can imagine the amount of capital you can have in that. And people say, oh, well, if the place burns down, it doesn't matter because they get paid maybe 70% of the claim. No, it doesn't work like that. The impact is basically that you've got people's lives and jobs and everything like that also in your hands. So anyway, risk management, very important. Technical underwriting assessments and justifications, part of the process. This is a non-negotiable. Reinsurers have come back to underwriters and said, on certain losses, what did you do? How did you underwrite this? Did you thumb suck the rate? Did the brokers say, well, I need a rate so much and you can have the lead on the program? Or what was your methodology? What kind of information or what kind of processes did you follow to actually get to a premium to charge for this risk? And it's becoming more and more part of the reinsurance audits on the insurance. Quality of reinsurance capacity is very imperative. Rashad also mentioned that just now. It actually lowers the capital requirements if you have a quality reinsurer, an S&P A- or whatever, as opposed to maybe a BBB- or something like that. It does impact the amount of capital that the company needs to actually perform the reinsurance side. What do we expect going forwards? Well, the Durban floods, as mentioned before, again, have created more awareness in respect of catastrophe mapping in the underwriting process. There's other mapping as well that they do, other modelings, but as a reinsurer, facultatively as well, we've got to take a look at where the risk now lies. There's a part of a big group, and is there 1 or 2 locations in what they call the Durban flood basin, for instance, just as one example. Where is it lying in relation to a river or a saturation zone? Rates will continue to increase as a result of the last 4 years underwriting results. I don't even believe that anymore. The floods Shame, COVID had a massive impact on a lot of industries as well. But insurers reinsurers haven't made as much money as they were expected, and they got shareholders as well. And then retrocessionaires behind them, we reinsure them again. Clients will need to take more intimate relationship, to have more information with insurers via their brokers. I think this is happening already. I've seen many conversations with some of the brokers where you can see that they have an ongoing dialogue with the risk management team, with the clients, with the broker, with the insurer, and sometimes the reinsurers also get involved. The larger ones definitely do have the capacity and also the resources to do that. So the link between the ultimate client and the reinsurer is becoming smaller and smaller. It's becoming tighter because I think it's becoming more on the basis of a partnership instead of just a business relationship. Reinsurance brokers are becoming more and more involved at the beginning of the process by retail brokers. I've seen this now happen a lot, where retail brokers know that it might be a capacity thing, or it's a more difficult placement or renewal. They would probably get RI broker involved at the beginning. It does give them bigger perspective and scope of what is out there, what is possibly sort of available to them as in markets, capacity, maybe even expertise, etc. Okay, more accurate and involved data is and will be required by insurers, which will be required by insurers. So this, I don't really give this one again. It's the whole data model, but further in this, though, the typical information that a facultative reinsurer needs is basically the same information that insurer needs. So there's a structure. How would you like to do the facultative part? Proportional, non-proportional. The risk appetite, what share of the risk is willing or able to retain? How much does the insurer want to keep? Do they want to buy a certain section of it? Do they want to do it for capacity? Do they want to de-risk maybe some parts of their book? We need a proposed placing slip or a copy of the schedule. Slip underlying values, very important. We need a schedule of each and every single location and addresses, deductibles and rates. Update a survey. If an old one, update risk requirements. We just need to update on the risk requirements, what's been done. Has the guy improved the risk? Has he done anything to it? Has he moved? Who knows? So we need those pertinent, proper underwriting information, and also claims history. Minimum of 3 years, we've got to see how those losses impact, what the new deductible structure would do to that, wording and a wording basis, of course, and all the covers that are involved in that. Right, so just side notes. Okay, how long is this hard market going to last? I've been asked that by a good couple of brokers. I think they know the answer anyway, but they just want to know from my side. I think it's gonna teeter off in about 2 years' time, hopefully. I'm hoping, because that means that there aren't any other natural disasters or major sort of loss events that'll impact it. As long as those are going on, it'll probably keep on hovering there. I don't think it's going to go down again. I don't think it'll probably ever go down again to the way it was like pre-2017, 2015. The soft market was around. I think it's almost where the base that we're going to get a flat level corrected market, if you want to call it like that. And hopefully sometimes based on performance, individual clients can maybe get discounts, or if the market gets more competitive, then so be it, then people can then start reducing rates. But just an example quickly, just average rate for development of plastic manufacturing. 2017, this is just a broad form example, okay? So don't hold me to it, and I'll continue you this, do this is. 2018 was 0.175, then it went up 2023, it's sitting at 0.45. So you can see the rating development on that basis. Now, 2024, we don't know. As I said, it's highly unlikely to go back within the next 2 years the way it was before. Definitely won't drop off that much. But who knows what to expect. And also, these are also individually priced risks. So each one has own merits. So the more protections, of course, that gives a better weighting on the over risk as well. New capacity coming in. They will be they'll be more cautious about deploying capacity behind the likes of a treaty or Neurus. They need to have expertise or experts who have adequate experience within this region, and also these the risk types that we have in this beautiful country called South Africa. What are the local sort of like, factors? How do they get around them? So new capacity from the likes of what happened in, say, just after 2001, 2002. I don't think there's going to be as many brand new people just coming in the market just to come and just make a quick buck either. There'll be very little cover for recycling, coal-related risks. I'll just use these two. There are a couple other risks which I don't want to mention, which probably are very, very unlikely to get capacity. I'm not saying there's no. I'm just saying that there are very few markets who still write recycling or coal-related risks. Of course, us writing for Lloyd's, we actually can't. We actually can't write coal-related risk because of Lloyd's stance on that. I know a few other larger reinsurers also have taken the same stance. Pandemic cover. Markets already done research on products developing or developed. I've seen it out there. There are a couple of markets who have actually gone back into maybe extending that cover. If they have the right amount of data again, they can do a proper risk assessment. If they can make a good judgment call, again, data information all the time. And yes, there you have it. I finished that, I think, in record time. There you go.
Andre, that was absolutely wonderful. Thank you. And I think just again underlining the importance of the reinsurers in the value chain of insurance and how complex it's becoming. I wanted to just add something to what you said in your insert earlier. I remember the days of receiving the reinsurance slips for our treaty placements, and it was a few pages long, 3-4 pages. And now these treaty slips are 12, 13 pages long with more specific instructions from the reinsurers all around the world as they're becoming more and more aware of the risks that we face. So as an industry, we have to hold hands and make sure that we all work together to understand the complexity that underwriters and insurers deal with as they go through the reinsurance renewal phases each year. So thank you to all our speakers today. It has been a very, very insightful day. And I think we can say that we are thoroughly versed on a high level on the complexities of the reinsurance industry. We again would like to thank our sponsors, Old Mutual Insure, for supporting today. And please join us next month for another insightful session. Thank you very much.